Let's just jump right in, guys. Welcome to The Explainer. Today, we've got a genuine financial detective story on our hands. We are looking at a company called Openlane, ticker symbol OPLN. And let me tell you, their recent data provides this massive wall of numbers that, honestly, at first glance makes absolutely no sense. It's just a massive contradictions, soaring highs, and dismal lows. But as focused learners, we know the truth is always hiding somewhere in the data. We just have to piece the clues together. Here is how we are going to crack the case today. 1. The Openlane paradox. 2. Unpacking the growth story. 3. Valuation, price versus value. 4. Financial health and efficiency. And 5. The final verdict. Okay, let's dive right into this. Section 1. The Openlane paradox. You know how stock analysis is often full of contradictions that we need to unravel? Well, rarely are they as glaring as this. Boom. 82.62%. That is Openlane's trailing 12-month total return. Seriously, if you held this stock over the last year, you are probably feeling fantastic right now. The market has rewarded this thing with a massive surge in price. Clearly, investors are seeing something they absolutely love. But immediately, we hit a total brick wall. This is the bombshell paradox. Over that exact same trailing 12-month period where the stock shot up over 82%, Openlane reported a deeply negative net income of minus $84.9 million. Yeah. How on earth does a company lose almost $85 million, yet its stock price rockets toward the moon? And because of those heavy paper losses, the classic PE ratio sits at a dismal negative 42.56. Now, what's really interesting about this is that a deeply negative PE usually sends traditional value investors running for the hills, right? Yet the price action tells us buyers are aggressively stepping in. To understand why, we've got to look way past the baseline income statement. Section 2, unpacking the growth story. If the present profitability is literally negative, investors must be pricing in some serious future growth or a massive turnaround. Let's look at the history here. Back in 2022, the stock suffered a painful negative 16.45% return. But then, the narrative violently shifts. It's up almost 34% in 2024 and logging a staggering 50.10% in 2025. This isn't your slow, steady compounder. This is a company experiencing a dramatic pendulum swing in market sentiment. But wait, because the contradictions just keep coming. We have an explosive trailing 12-month earnings per share growth of nearly 95%. Incredible, right? But contrast that with their 5-year revenue compound annual growth rate, which is actually negative 1.17%. Their top line is shrinking. So the crucial takeaway here is they are somehow squeezing out massive short-term EPS growth without actually growing their long-term sales. And then we get this major clue, a PEG ratio of just 0.20. As you know, the PEG ratio measures a stock's valuation against its expected growth rate, and anything under 1.0 is generally considered undervalued. At 0.20, the data is practically screaming that, despite the heavy losses on paper, the stock might actually be dirt cheap relative to its explosive short-term growth trajectory. Section 3, valuation, price versus value. So let's recap. We have soaring prices, negative income, shrinking revenues, but amazing short-term EPS metrics. It's honestly dizzying. So let's see if we can find a reliable anchor for what Openlane is actually worth. Checking out how it's trading relative to its own history, it's a bit alarming. The price-to-sales ratio is flat against its 5-year average, but the price-to-book ratio is trading 76% higher than its historical norm. Price-to-free cash flow is also nearly 69% above its 5-year average. So for sure, the market is paying a premium right now compared to what it historically paid for this exact same business. To cut right through the noise of those market premiums, we use the discounted cash flow, or DCF model. This is that strict valuation model that estimates the intrinsic value of a stock based purely on the present value of the actual cash it's expected to generate. It totally ignores market hype and just follows the cash. And this brilliantly illustrates what's going on. The current trading price sits at $34.90, but based on that rigorous DCF calculation, the fair value price is $36.13. So after all the wild 82% run-ups, the negative incomes, and the shifting revenues, the market has actually priced the stock almost exactly where it fundamentally belongs. And because the price and the fair value are so incredibly close, our margin of safety sits at a razor-thin 3.39%. For a value investor, that margin of safety is your cushion against being wrong. At barely over 3%, there is literally almost zero room for error here. If Openlane stumbles even slightly, buyers at today's price have basically no buffer. Section 4, Financial Health and Efficiency. To figure out if Openlane actually might stumble, we need to look past the stock price and examine the underlying engine. The debt-to-equity ratio is 1.46, which is definitely elevated and tells us they're using a fair bit of leverage. However, the current ratio is 1.16, meaning they do have enough liquid assets to cover short-term liabilities. And most impressively, the return on invested capital is a solid 8.36%, so they are actually making efficient use of the capital they deploy. But right here is the metric that solves the entire Openlane paradox, a massive free cash flow yield of 10.07%. Remember that $85 million net loss we kept talking about? Well, accounting losses don't always equal cash losses. The data reveals Openlane actually generated over $372 million in pure free cash flow over the last 12 months. That is real, tangible cash the business is throwing off, and that, my friends, is exactly why investors are buying. But just to keep us grounded, look at how that massive cash generation contrasts with their traditional efficiency metrics. Return on assets is negative 1.78, return on equity is negative 5.50, and their net profit margin is a microscopic 1.12%. It is such a fascinating business because it looks terrible on a traditional income statement, but it's an absolute powerhouse on the cash flow statement. Section 5, the final verdict. All right, we've dug through a lot of data today, and it's time to synthesize what it all means. First, we've got to acknowledge the incredible momentum. An 82% price surge shows huge market conviction. Second, we totally solved the paradox. The company might be reporting an $85 million paper loss, but that is completely eclipsed by a phenomenal 10% free cash flow yield. They are generating huge amounts of real cash. But finally, we have to recognize the risk. The market has absolutely caught on, driving the price up to almost exactly its fair value, which leaves us a microscopic 3.39% margin of safety. Which leaves us with the ultimate question. You know the cash flow is incredible, but you also know the easy money has likely already been made. At a razor-thin 3.39% margin of safety, is OPLN a buy for your portfolio? I'll leave you to weigh those clues for yourself. Thanks so much for joining me on this explainer, and keep learning.